Investors' interest rate worries have continued to weigh on the markets. And while the expectation is for the next move from the Fed to be a rate cut, our first guest today says, well, you don't want to take a rate hike out of your calculations, potentially. Let's welcome in Skyler Weinand, Regan Capital CIO. Skyler, thanks so much for being here. There have been a few out there, including the likes of Larry Summers, who've said maybe we should be getting a hike here. Do you think we shouldn't? Do you think that's actually a possibility?
Definitely. I think, one of the first things Jay Powell did when he got nominated and elected as a Fed chair is really look back onto history in terms of, what Volcker and what Greenspan and some of his predecessors did. So he's a student of history. He's a pre-GFC guy where, he's very concerned about the U.S. consumer. And he's very concerned about inflation not coming down. Inflation is really what is affecting the economy, not the stock market, not real estate. It's folks that earn a W-2 and are spending more money at the gas pump in the grocery store. So if anything... But
Skyler, the economy is doing just fine, isn't it, by most metrics? That inflation...
That's the problem, right, is that there's a tremendous amount of wealth that's been created since COVID. $40 trillion in U.S. wealth has been created since the year 2020. That's housing, that's the stock market. So financial conditions are excellent. It begs the question, why would they even think about cutting rates?
So
when
Skyler,
inflation's high and unemployment's doing great.
Skyler, what's your base case there? Is your base case they just hold steady this year?
Yeah, for sure. And they have a very, very minute window to cut, which is June. That's the only possible time for them to cut. They're not going to cut in July, which is in between the Republican and Democrat convention. They're not going to cut in the fall right before the election. So June is the only possibility for them to cut. And the data is telling us that why? Everything's going great. If anything, the economy is running too hot, and they might need to raise interest rates.
Okay, so if they are not going to cut this year, stocks until recently, until we saw yields start to rise more considerably, stocks were holding up pretty well. So what happens with yields? What happens with stocks if we don't get any move this year?
Right, so we see the front end of the curve, T-bills, twos, kind of staying where they're at, 5.25, 5.5 on money markets. Twos are right at around 5%. What's going to happen is the back end, anywhere from 5 years out to 30 years, are going to continue to increase. So that's going to hurt traditional fixed income. It's going to hurt long dated munis and bonds. But I think we're just getting back to normal. We've had an inverted curve for almost 2 years. Yeah, we might see a bear steepener, which means the back end increases, and that's going to bring stocks down to normality, so to speak. We were just at almost 10% gain in the first quarter here. Now we're back to about a 6% gain, which is still an annualized 18 to 20% gain. But I think earnings are going to do great. The economy's great. Corporate balance sheets are great. The interest rates aren't really affecting them, and they're not really affecting consumers, the bulk of which are locked into a 3% mortgage. So interest rates and higher rates haven't really had much of an effect on the economy yet, and it might take an extra year or two to see that.
And Skyler, let me just get your quick take, though. Going back to yields, you're seeing some relief today, but 10-year, we are back to 4.58 here. At what level is that, Skyler, a problem for the stock market? Is it here? Is it 5%?
It's well above 5%, if not 6%, right? I think we were at 5% on Halloween of 6 months ago. And memories are short, but we rallied really quick from 5 down to 380. Now we're back to about 4.6. I think we can at least tolerate 5. Once we get to 6, then it's hey, can companies really pay that, as a new cost of capital when it's been 3 to 5 for a long time? But when that happens, we'll again have a steep curve, which benefits traditional fixed income, benefits even corporations that carry trade, where they can borrow short and invest long. So that steepener, while it might be a little bit painful if you own long duration, will eventually help the economy.
When are we getting to 6, Skyler?
It could be quicker than we think, but I think that's when you really go all in on fixed income, especially longer duration fixed rate assets. We hear people every day from the big institutions saying, hey, now's the time to buy fixed income at 4.5% or 5%. But if you're buying it into an inverted curve, traditional fixed income metrics and ways of doing business don't work. Bond ladders don't work. The carry trade doesn't work. So we could see, and we had a really bad 30-year auction last week, where the tail was something like 6 basis points above where the market was trading. So I don't know if the demand's there on the long end, whether it's pensions, insurance companies, or foreign governments. But yeah, I think we can survive upwards of about 6% before we really see that effect seeping into the stock market.
Skyler, thank you so much for helping us kick off the show today. Appreciate it.
Thank you all.